now there is a general perception in the market that coffee can, being large cap or large cap oriented, these businesses are always expensive.
Right.
And since they are expensive, whenever there is a decline in PE multiples, not for the fault of the company, because of the headwinds, because of the global macros, despite the earnings growth, the investors are not able to make money. And this is what happened in calendar 22. Despite of having a stupendous 6-year record, in 1 year, coffee can got hit badly. What's your sense on it?
Yeah, Siddharth, so you rightly mentioned that one of the key aspects that we have to look for is that when as an aggregate that we always balance. So one of the issues that you see in coffee can which happened is that on a sector wise, if we see, they were very lopsided towards one particular sector. So I think the way the endeavor would be, the way you would like to address this is to not have such high concentration in one particular sector, which for various reasons, whether macro or company specific, could get impacted. The idea is that you can find quality coffee can type companies in various kind of sectors, and having identifying companies maybe which are in different sectors but bring in the same characteristics as we are looking for in one or two sectors which are at a particular point of time more expensive, or where growth is becoming an issue, is one thing. The other is our entire approach of trying to buy companies with pricing power. I think that negates some of this risk of P derating and companies seeing correction, because irrespective of how a particular cycle is going in different industries, companies with high pricing power are typically able to prevail even in environments where earnings are under pressure because of high inflation in raw material, or even in periods where where growth sees a headwind. These companies are then able to play on their pricing power and increase prices more, and hence increase their margins. So I think a mix of having a well balanced portfolio across different industries and essentially looking for companies which have high pricing power would be one of the ways which you would look to look at addressing the risk you mentioned.
So very well said. Pricing power, diversify the portfolio with sectors, don't have too much weight into a particular sector. And number 3, which is critical, look at what can be the future sector. So start anticipating, start looking at the macro cycle and play on it to a certain extent.
Sure.